नहीं
वो ले आऊंगा सर,
हाँ,
अभी
ले
तो
लेना।
ठंडी है ना, चला लीजिए काम।
अभी है फिर भी रिमाइंडर में स्टॉक अप earlier.
आज मैं ले आता हूँ आपको।
Yes. Okay, 882. Can you hear me?
Yes, sir.
Can you hear me now?
Yes, sir.
Yes. Okay. Good. Test. I have to get the internet. This guy, where I tested is here. Alright, 1 minute में इंटरनेट देख लेता हूँ. Alright, so let's just quickly continue our discussion of models. We'll just do a little bit of testing and then we'll hopefully move on to the next part. Okay, now here, this is the NPV model, so I just want to test, Jen, what is the endogenous variable in this? Have you seen this NPV model before? You have? Okay, so what is the endogenous variable in this NPV model? 1 minute, I'm asking Jen. What? Font size. Let's see if we can make this. It goes out of view. Okay, so you're saying font size, adjusting font size is a better way to do it. Okay, if I just make. No, sorry, it's 14, right? So let's make it 18. So this model, this link is already there in your. No, this will also not work. So we have this first module in your notes. Okay, guys, be quiet. Be quiet here. Okay, so we have this first module in your notes. Okay, you should start doing the readings in this sequence. All right, this is your first module in the notes, and then here we have a discussion. At some point, we have a discussion of models. So this, I put the hyperlink in here. You can click this link. At this stage, we went into the discussion on models. When you click this link, this file will open up. This file is also in your folder, okay? So you can have a look at this, and then we are discussing this now. Where are we in the NPV model? Is this clearer now? Yes. Actually, this font, the font color here is a little light because I just copied it from somewhere because I didn't want to have to write it, because we want to make sure that everything is on the screen rather than me doing it on the board. Then it doesn't get captured in the video. Right. So Jayant, you're familiar. Can you read this now? Can you read all this stuff? The NPV model you're familiar with? Okay. So tell me now, we're just doing some quick revision from the last class. Okay. Nikhil, why don't you sit here? That'll be good. I don't think Gaba's coming. Come and sit next to Sonam. Okay. All right. So what was I saying? Okay, the NPV model, you've already done this before in your FM1, FM2 project NPV analysis, right? Now, what is the endogenous variable in the NPV model? Only Jayant. Be quiet. Everybody else be quiet. Quickly. Remember we discussed endogenous, exogenous, etc. in the last class? So I'm just testing now. I'm just doing some refresher testing. Yes?
Yes, sir.
Any answer? What is the endogenous variable in the NPV model?
Sir, which is generated within
No, I'm not asking you to define the endogenous variable. Now I'm asking you point out to me this model has many variables in it.
Yes.
Now I'm asking you to point out to me which the endogenous variable is.
Sir, NPV.
NPV? Okay, what about you, Gunjan? What is your view? You don't have a view?
Sir, I was not there last week.
You were not there last week. So what is your responsibility when you missed the class? You should have revised the class. Okay, Nikhil, what is the endogenous variable in the NPV model? Is Jayant correct?
Yes, sir.
He's correct. NPV is the endogenous variable. Okay, Nikita, what is your view? You remember the question? Yes or no? Yes. So is Jayant correct or no? I can't hear you. Sorry, give her the mic. Yeah, her voice is very soft. Yeah. So according to you, the discount rate is the endogenous variable. Okay. So now Sandhya has a problem. She has to decide whether Nikita is right or Jayant is right. Yes, tell us. You heard her answer? According to her, the endogenous variable in this NPV model is the discount rate. According to Jayant and Nikhil, it's the NPV. Now, whose side are you on? You are with Jayant. Okay. What about you, Himani? Yes? NPV is the endogenous variable? Okay. What about you, Kanika? NPV? Okay, good. That's not a very strong, I mean, you're just very weak response. Okay. All right. Okay, guys. So Jayant and all are right. Jayant and company are correct. Yes?
Sir, NPV or sir, if we take it as an IRR or then discount rate also, so both are endogenous.
No. Now you have created more confusion. Okay. In most of these models which you are using will have typically only one endogenous variable. Most of the models, okay? Theoretically, when we define the model, that's why we put output and bracket S outputs, because theoretically when we define models, we should be able to capture all types of models, and many models will have multiple outputs, okay? So that's why we define a model generally. But most of the models that we are dealing with, you have only one output. Okay, so in this case, the endogenous variable is NPV. Okay, what was the other one you said? Discount rate.
Sir, if it is not given, sir. Oh, it will be given that is.
No, it's not given. You still have to use the input. You have to still estimate the discount rate. When you do a typical project NPV analysis, what is it? When you're analyzing when the project is funded by both debt and equity, what is the discount rate that you use? The WACC. Okay, so when the project is funded by both, you use WACC, otherwise you use cost of equity when it is purely funded by equity. Okay, so now so therefore you still have to estimate those numbers, and there is subjectivity. Remember what we discussed in response to Goyal's question, that he was surprised that it was all subjective. Remember when we were discussing models, valuation models and M&A? So he was a little surprised that everything is it's all subjective, but be very clear that this is all subjective. Okay, so if I give you the same project case study, and then Aryant will have a different cost of capital, and you will have a different cost of capital quite likely, okay, based on the assumptions you make. Okay, so therefore based on it will differ even based on things like what period, because even the beta calculation that you do for your cost of equity, if you estimate the beta over 6 months of data, you'll get one beta if you use the same equity, same stock. But if you just change your period from 6 months to say 2 years, your beta number will most likely be different. Okay, if it's the same, it's just a coincidence. Most of the time, be different. So there are lots of reasons for differences to arise, even in the cost of capital. That's the discount rate. Okay, so all of these will come. But the point is, when you are looking at the model per se, I think why you got confused is that these things also have to be estimated, okay? But these are not endogenous variables in the language of models, okay? Because when it comes to the model per se, you will estimate all that stuff. You will estimate your cost of capital. Most important estimate that you're doing here is the C1s, the CIs, okay? This is the most important estimate that you're doing. So in most of these kinds of fair value models that you're going to do, you have to remember that the biggest source of error is the CIs. Okay, normally there wouldn't be a huge amount of variation if you look at different analyst estimates. there wouldn't be a huge amount of variation in the cost of in the discount rate. Okay, there will be variation, but the variation will not be wide. Okay, but if you look at different analysts and their estimates of the CIs, it will differ widely. That's why I keep coming back to the example of Tesla. You'll see that if you look at the market for Tesla, the analysts, there is a very wide dispersion of views. Okay, because of the industry that is in and all that. So that's very natural. That's what happens in the real world, and that proves to you once again that this is all subjective. Okay, everybody has the same basic information. Everyone knows how many cars the competitors are making, how many, because all the other competitors are also moving into electric cars. Everybody knows Tesla's production numbers. The information is the same for everyone, but using the same information in the background, the same FA information that everyone has, people come out with different estimates for the CIs. Okay, so that you have to understand as part of the whole modeling process, because you may be doing a lot of this in your work, although I personally think the utility of these things actually is very highly overestimated. Okay, people don't. That's why you'll notice that. One thing you'll notice when I have asked you to follow people like Jeffrey Gundlach, Warren Buffett, then Howard Marks, all these people, right? And even I also mentioned about Lloyd Blankfein once, where he was asked about predictions, and he said, I don't focus so much on predictions, but I don't spend so much energy on predictions, but I spend more energy on the risk management when the prediction goes wrong. Okay, so one of the things you'll notice is that people who actually have to manage money, okay, like Howard Marks and all these people, they don't focus too much on these. They don't spend. In fact, Warren Buffett doesn't do any. You'll never see him doing all this modeling. He just does some back of the envelope calculations, and he decides to invest few billions of dollars, right? So, and recently he's invested in an Indian company. Which Indian company was that? Paytm, I think, right? So he invested in Paytm as well. He wouldn't have done all these. He would have just looked at the overall business strategy, and they focus more on the people. He would have focused more on the people. He would just meet the managers and then take a decision based on his gut feel. Okay, right. So what I was saying is that this discussion is important because it is important for you to understand that the CIs are the biggest source of error in the models. Okay, I had mentioned to you earlier about the TXU situation, which was a $47 billion leveraged buyout. Okay, which went for a toss. Eventually, the company had to declare bankruptcy. That is essentially because whatever they had forecast for the CIs, that stuff went horribly wrong. Okay, because natural gas prices collapsed, and those CI estimates eventually they just became a joke. So the company didn't earn anything, and they eventually had to declare bankruptcy. That was a $47 billion. So I think it's very important to have this little part of our discussion where we talk about the fallibility of these models. Okay, and so if you take that example of TXU. Okay, and the people who invested, who decided to invest in TXU were very well-known names in the industry, like KKR. Okay, not your version of KKR, but Kohlberg Kravis Roberts. Okay, which by that time had already, I think, changed their name to KKR. But Kohlberg Kravis Roberts is the preeminent LBO firm. This is the firm that essentially brought LBOs to the limelight. Okay, so if you see that film, Barbarians at the Gate, that is based on the Kohlberg Kravis Roberts takeover of RGR Nabisco. Okay, so these are the guys. So these are the gods of the LBO process. Goldman Sachs was one of the investors in TXU. Okay, so all these big name investors, and they all messed up big time. Okay, why did this happen? Because it's a fact of life. No matter who you are, even Warren Buffett has made a big mistake now, which is the company that he invested in has recently. Yes, Kraft Heinz. Very good. At least some people are keeping up with what's going on. Yes?
$4 billion, the valuation was down by 4%.
I think it was more than that. I think it was from 11 or 16 or something like that. They had to write down a lot of their goodwill. Okay? So this is the reason this was a problem, and the SEC is also investigating them for this and other accounting thing. So the stock has collapsed dramatically.
Yes.
Okay, so actually Warren Buffett just being interviewed, you can check that interview actually. CNBC just interviewed a pretty big interview, and he is actually admitting in that interview that he overpaid for Kraft Heinz. Okay, so you can see how fallible. So it's very important, because all the other courses that you will do when you go outside, you'll find that every Tom, Dick and Harry is peddling courses on modeling. Okay, and that's because people have a fetish for all these things. Okay, so they're catering to that fetish, and these people will never tell you about where the risks are, because if they tell you that these things are very fallible, if they tell you that the real investors like Howard Marks, Warren Buffett, those who actually have to manage money in markets, these guys don't rely too much on these models, okay? Then what will happen is that will reduce the importance of models, perceived importance, so then they can't sell their courses. You understand that? I think you should also understand the politics of all this and the marketing aspects of all this. Okay, so the guys who are teaching you or giving you all those courses, they are never going to tell you about the pitfalls of these things. Okay, so it's important to be aware of these pitfalls. So don't fall in love with these things. These are just, you should know what you need to know as an MBA student is you need to know the theory behind it, you need to know how it is constructed, you need to be able to know how to do it using your office productivity software like spreadsheets and stuff. You should know how to do these things, but in your mind you should have a deep skepticism about these things. Okay, you should be aware of all the case studies of how these things have failed. Buffett Kraft Heinz is a big example. He's saying we actually overpaid by almost 100 billion according to one of his frameworks, where he's talking about how much capital they're actually employing, how much tangible capital they're employing in the business. Okay, and he's saying we overpaid by almost $100 billion. Okay, for the Kraft piece of it. The Heinz was already there from before, but the Kraft piece of it they overpaid. So you can see somebody like Warren Buffett with so many years of experience and such a smart guy, okay, and he's made a mistake, because it's not that it doesn't make him a fool, okay. It doesn't mean that KKR and Goldman Sachs were fools for investing in TXU. It just means that it's just an affirmation of the fact that life is very uncertain. So is business life, so is the economy, and so are asset prices. So you need to have a healthy respect for this uncertainty. So don't think that you can really predict anything. That's why people who actually manage money, who actually have to run risk books, like people like Goldman Sachs' Lloyd Blankfein, who comes from a trading background. That's why when he was asked, he said, what did he say? He said, I don't spend too much money on the prediction. I spend much more time on the risk management. How am I going to manage the risk if things don't go my way? Okay, so the real people will, the real money managers will always give you this kind of, bias towards more of a gut feel and more of a focus on risk management. Okay, never mind. So we have this. So the important thing to understand, most of the time, this is the riskiest part of the whole ball game. The CIs. Okay, the forecast of the CIs, and this is what makes the whole thing subjective. Remember, these are all subjective. Okay, these are fair value models. These are all subjective. Okay, so we've done this. Now let's just quickly. I want to just discuss something else. Okay, I will add. Okay, so what I'm going to do later on, you'll find I'm going to just paste it into your. All right. Okay, I'm going to just paste it this part. Okay, I'll do it after the class. So I have written a big. Reasonably. There should be more material. Yeah, there is some data here. So it's a big segment actually on stationarity. Have you heard these terms? Stationarity, non-stationarity of time series data. You haven't heard these terms? Okay. So these are slightly advanced concepts in modeling, which essentially deal with the topic of what makes the models fail. One of the things that makes models fail. Okay. So so there's some material that I put here. What I'm going to do is non-stationarity, things like non-stationarity, robust estimators. When you did statistics, did you do robust estimators? R-O-B-U-S-T?
No, sir.
You haven't done that? Okay. So essentially a robust estimator is one that is not going to, will remain accurate even though the underlying assumptions of the model change. Okay. So these things are important concepts. So what I'm going to do is, this entire block, you will see that it will be pasted in your note here. Okay. This particular note here that you have, this V1 predictive models, I will paste this, okay, from my version into your version, but I will leave it as out of the syllabus because these are actually quite complex topics, okay. But I want you to read for your own benefit as a finance student. It will be kept out of the syllabus, but you should read it on your own, okay, and try to develop at least some feel for these ideas. At least be aware of these terms, okay. Things like non-stationarity, which is nothing but it just talks about the instability of the time series, okay. So essentially time series data in finance and economics, okay, like you look at the euro dollar FX rate over here. Essentially what we are saying is that this time series is unstable, okay. I'm giving you a layman's version of non-stationarity, okay. What I mean is just that the time series, you see how the nature of the time series is changing. Visually also you can see there's a type of movement here on the left panel. But after this point, the nature of the movement has changed. Can you see that?
Yes.
Up to here, like if we make this a little bit more, if I make this 4 hours, you can see other kinds of changes in the distribution. Okay, so essentially, it's good to have a layman's understanding, a loose understanding of a non-mathematical understanding of non-stationarity. All right. Now you see there are many. See here that there was a different type of distribution. The price was moving in a particular way. Okay. Then you can see here also there are some changes. All right. And then, okay. So when you look at any time series, any kind of time series data, you will see features like this. Can you see here? There's a lot of up and down movement. There's a lot of volatility. But here in this period, the volatility tends to collapse a little bit. Can you see that visually? Okay, so when you look at a time series data chart, you look out for these kinds of things where you can visually detect that the nature of the distribution is changing. Okay, so this is what loosely non-stationarity refers to. Okay, so these are the things that I'll be these have been discussed over here in this note, and I will put it into your note. It will be kept outside the syllabus, but I think it's a very important thing to be aware of. So for your own good, you should read it. Okay, and the last conclusion that I will tell you, which you should which I will actually tell you. I'm not going to go through the whole thing, but the net effect of all this is something you should remember, because when you go into the industry, people will come and very often present you with models. Okay, they'll come and say, oh, I've got this. Is very common because there's a big business in selling all these kinds of new models and things like that. You can see with many people selling modeling courses and stuff like that. So now people will come and sell you to more and more complicated models, okay, and they'll try to show you that the forecast accuracy is very high. You're familiar with R square and all that? Yes. Okay, so they will try to show you there's a very high R square. Okay, it is able to explain most of the data. Okay, but you have to be aware of one simple rule. I'm telling you, I'm just going to give you a simple rule, which is this here. Okay, in general, you should always trust very crude and simple models. Okay, don't get seduced by overcomplicated, over sophisticated models. Okay, because this will have these things. When you read the whole segment, you'll understand why. But I'm giving you a thumb rule. As a general rule, always distrust models that are too complex, too many explanatory variables. Now you know what explanatory variables are. Okay, if you keep on adding explanatory variables, you can improve the R square. Okay, but that is not a very smart thing to do, because eventually you have to use it on real live data in the future out of sample testing. Okay, so as a general rule, remember this, that crude and simple models are much better than more sophisticated models with too many explanatory variables. Don't trust those types of models, because typically when people come and try to sell you models, they'll try to sell you models which look very complex, because human beings have a fetish for complexity. If I show you something which is lots of equations, looks very complex, okay, people will be very impressed, even though actually it may be all garbage in terms of content. But people get impressed when they see all these equations and wow, looks very complex, must be good. Okay, this is a human fallacy that we all have, most of us. So you have to guard against this. Okay, so I just wanted to have this discussion. And later on you read it. It'll be kept out of the syllabus, and but you should still read it for your own good. Okay, so we've done this part now, and what we will do now is, okay, let me just go into. Is your calc file open? Yeah, okay, your calc file is open. So now I'll just continue. We are just going to spend, yeah. All right. Now, guys, let's just go. We'll just continue our model module. Okay. Modeling module. Let's go back to some basic. Remember, we did a discussion. We enumerated we listed out all the decision problems that exist in managing an investment portfolio, right? Okay. Now, can you tell me when we have all this discussion on modeling and things like that, all these NPV and all these things which you are doing, what decision problem? Remember, typically what happens in most of the finance courses is that things like valuation, Damodaran has a book on valuation and all that. So there's a lot of discussion on valuation in most finance textbooks. But typically valuation tends to fall from the sky. Suddenly you have valuation. Okay. Now if I connect you back to the decision problems, the listing of decision problems, we have a bunch of decision problems here. Let's just do it here. I'll wipe it out later. Okay. We have, what are the decision problems in managing investment fund? Which asset class to invest in?
And which instrument?
Okay, which asset class, which market? Okay, what instrument? Okay, or buy or sell? Entry,
Entry and exit.
exit will have two parts.
And profit or loss.
Profit or loss. Okay. And have we missed in one decision problem?
Units to buy.
Number of units.
Number of units.
Position size is also a decision problem. Okay. So amount. Let's call it amount. Okay. So these are just loosely listed over here. Now tell me, because remember the whole the structure of the entire set of electives is all anchored in decision problems. We are not interested in things which are not going to help us to solve decision problems, right? Because the decision problems are all that matter. So now when you want to teach me valuation, now I ask you, now why do I need valuation? Which decision problem does it help me with? Okay, you can always ask this fundamental question: why do I need to learn about asset valuation models? Okay, which decision problem does it help me with? Is my question clear? Buy and sell. Who's saying that? Shivani. Okay. Anybody has a different view? Bola? No? You agree with her? Okay. Yes. Sandhya? You agree? So it is always buy and sell. Okay. So you should also have this connection in your mind that this whole valuation discussion, because most of finance theory is kind of focused on the valuation discussion, different aspects of it, how to calculate cost of equity, how to calculate cost of debt, this, that, okay, how to calculate WACC, should we use the same WACC for all the periods, all that stuff. So it's all focused on valuation, most of finance theory. But so what you have to understand is that valuation is really relevant in the context of the buy-sell discussion. Okay, the decision problem relating to whether I should buy the base asset in a particular market, having chosen the market instrument combination. Now do I buy or do I sell? Okay, that's the decision problem in the context of which valuation arises. Now what is very important to understand, this is again in your folder, you don't need to copy any of this. Okay, so now I had, can I just delete the first row? Yeah, we get more of a view. All right. Okay. So now this, pay attention to this framework again. This is important from a perspective point of view. Okay. We won't have time to go into every aspect of this, but this whole discussion is happening in the context of option models. Okay. So remember now this valuation thing is relevant in the context of the buy-sell decision problem, right? Now what you have to understand is, now typically when you have the discussion of valuation in the finance textbooks, you are not really given an you would typically end up with an impression that the valuation aspect is important for whenever you have to solve the buy-sell decision problem, you need to go into the valuation aspect. Are you following what I'm saying?
Yes, sir.
Typically when the valuation discussion happens in finance textbook, it's not explicitly discussed, but the impression you would get is that whenever you have to solve a buy-sell decision problem, you need to go through the valuation exercise. Are you following?
Yes.
Okay, you agree with that assessment? Okay, but this is not actually correct. Okay, what you have to be aware of as finance students is that there are two broad approaches to solving this buy-sell decision problem. It's a very important decision problem, okay, although not the most important, but this is what most finance theory focuses on, the buy-sell decision problem. So what you have to be aware of, let's look at this first distinction, okay? There are two broad philosophical approaches to solving the buy-sell decision problem. Okay, one is what we will call, let's look at this first. One category is value agnostic. You know what agnostic is? Agnostic is someone who does not know, okay, or is not really interested, doesn't really care. Okay, so typically when we talk about religious people, we contrast them with one category which is an atheist. An atheist is, these are not well-defined terms, but I'm defining them precisely. An atheist you should define as someone who is convinced that there is no God. Okay, a religious person, okay, like a Christian or a Muslim or a Jew, is convinced that there is a God and the God is Jesus Christ or Allah or whatever, okay. As that's a religious person. Then you have an atheist. Atheist should be defined as a person who is convinced that there is no God, okay. And then the third category is the agnostic, who is not really sure. I mean, he's not decided either way. He's kind of not really sure, doesn't really care. Okay, indifferent. He's kind of indifferent. Okay, so that way, this way you get to define a distinction between atheist and agnostic. Okay, atheist is sure that there is no God. So this guy is absolutely sure that he is not sure. He's not sure either way. Okay, he's unsure, indifferent, doesn't care. Okay, doesn't have a view. Okay, so what we are saying is that there are two broad approaches to solving the buy-sell decision problem philosophically. One is what we call a value agnostic approach. Value agnostic means I'm not interested in what value is. I don't really care. I don't care about what the value is. Okay. So in general, whenever we are saying value here in this context, we are talking about fair value. Okay. We'll have further discussions on fair value, but essentially value is fair value. So this value agnostic approach, we don't care what the value is. That's the essence of this approach. Okay. And this is where TA falls in. Okay. So TA is pure price based analysis. Remember, there's a distinction between price and value. Yes, people are looking blank. Which is, Vibhu? Which is subjective and which is objective? Between price and value. 1 minute, I'm asking her. You understand these two terms, price and value? Which is subjective and which is objective?
Value is subjective and price is objective.
Good. So value is subjective and price is objective. Always remember this, okay? Because we are using these terms very carefully. So when we say value, we are typically referring to something. Valuation is, there's only one exception to that term, which we will see later. But other than that, whenever you use valuation models, these are all subjective, okay? And price is objective. Price is what you observe in the market, so it's objective, okay? So price is objective, value is subjective, okay? So in TA, as we have already discussed, you guys are already familiar with TA. TA, what do? We don't really care. Let me see if I have one of these things. Okay, all right. So we don't really care. In fact, I can just do this here. I have this Euro chart as well. I can just take a view here if I'm doing TA. Okay, now here we have the Euro USD spot FX exchange rate. Okay, so it's an important question. Which way is this going to go? Should I buy or should I sell? Okay, and so obviously forecasting is related to the buy-sell decision. If my forecast is bearish, then I will sell. If my forecast is bullish, I will buy. Okay, here, which is the base asset in this market?
So Euro.
Euro is the base asset.
And US dollar is the term asset.
US dollar is the terms asset. Is this clear? Okay, so now I need to take a view on this market. I need to decide whether to buy or sell. Now, if I do this, now remember there are two ways to do this. One is a value agnostic approach and the other one is the price versus value, which we haven't come to yet. So the value agnostic approach is essentially what TA is. Okay, purely price based, agnostic about value. I don't care what value is. Okay, I don't care what the fair value of the euro is. Okay, so what will I do? I will look at this and I'll say maybe there is a downtrend here. Looks like there's a downtrend here. I see a series of lower lows, lower highs. Okay, and this most important lowest high here has not been broken to the top side. Okay, and then they came down, made another lower low, and it looks like overall it's bearish. Okay, so I'll look at a trend analysis. There are many more sophisticated ways to do TA. TA is a subject by itself. You can actually do 3 courses on TA itself. So it's a huge body of material, but I'm just giving you a crude version of TA. Okay, when I look at the trend, it's like I'm surfing waves. And I look at the trend, it seems to me like that there's a downward trend over here. That's a reasonable assessment, you think? That's a reasonable assessment. You could look at this and form a view that especially if I'm a momentum player, okay, if I'm a momentum player, that's a reasonable assessment for me to make. Okay, so then what I do is I'll assume that the other decision problems are solved. In this case, I just decide to sell it, okay? And I can sell it at market, etc. and all that. I can decide number of units. So basically I've solved my buy-sell problem. Is this clear? I've solved my buy-sell problem. Did I refer to value at all?
No.
Okay, so this is the first thing you have to understand, to have a comprehensive understanding of different techniques in finance, okay, and how they connect to the decision problems. So it is not correct to imply that for every solution to the buy-sell problem, you need to do a valuation. You don't need to do valuation if you only believe in TA. If you don't believe in FA and the other approach, if you are philosophically committed to the TA approach, okay, then you are able to solve the buy-sell problem without any reference to valuation. This is an important thing to understand. Is this clear to everyone?
Yes.
Be clear about this, that you can solve the buy-sell problem without any reference to valuation if you buy into the TA religion. Okay, we can call TA religion. It's a belief system. Okay, you believe that this is all that matters. Value is not important. Okay, and you practice TA. So is this clear? First thing. Okay. Now, so this is what is meant by value agnostic. I just look at price trends. I could do all kinds of other stuff. Like I could just come up with an indicator. Okay. You can, maybe we should spend, should we spend time on, I think you understand TA now. I don't think we need to spend time on indicators. Okay. There are other things you can do, like following, I'll just briefly show you other approaches that are possible. So here's SPY. Okay, let's take two of these, and where are the indicators? Here. Let's take a moving average. We haven't, have I explained moving average? No. Okay, it's just the average of the prices. Okay, in particular. So now you see I did a 50-day moving average. Can you see it here? Can you see it? So another type of TA approach would be again to say that, okay, now the price has risen over the 50-day moving average, so I'm going to buy it. Okay. Now all you need to know at this stage about the 50-day moving average is that it takes 50 days of data at a time. Okay, and keeps on shifting forward. So today it will take the last 50 days. Yesterday it took the last 51 days. Okay, leaving out obviously yesterday's price. So that's how the thing keeps shifting. The 50-day moving average is just the average of the prices. So here again, am I referring to value? No reference to value. I just look at the market price. I do some manipulations of the market price. These are manipulations of a moving average is a manipulation of the market price. Okay. In mathematical language, we say manipulation. I've manipulated the market price by taking an average, a simple average. Okay. So once again, you see, I solved the buy-sell problem. Price went over the moving average, so I buy. Price goes below the moving average, I sell. I've solved my buy-sell problem. Okay. Without any reference to value. This is clear to everyone? Okay, so you should be aware of this. Okay, we've maybe spent a little bit more time on this topic, on this point, but it's important that we hammer it in. Okay, now come back to the framework. So now you understand what TA is. So there are all these kinds of subcategories within TA. Okay, you can see momentum mean reversion, which you have already discussed. Okay, so this is the whole subject by itself, which we don't have time to go into right now. At this point, I'm just highlighting this point. Now contrast TA with what I call the value versus price comparison based analysis. Okay, so in the other approach, one approach is to completely forget about value, be agnostic about value, just look at price and do the job with TA. The other approach is based on a comparison between price and value. Okay, this is the other approach to solving the buy-sell problem. So this is what I'm calling the value versus price comparison based analysis. So in all these techniques, you are essentially, what you are doing is, the framework you're using is you're comparing value to price. Okay, and so typically the way you use this framework is value versus price comparison based means that if you find that price is below value, what will you do? Will you buy or sell? If price is below value, you will compute the way this framework works is, the way this family of approaches will work is, you will first calculate the value, because you don't have to calculate the price is visible to you in the market, you can see the price, it's objective. Okay, you do need to calculate the value. Is this clear? You need to calculate a value, you calculate a fair value. The way the framework works is like this, okay, which is, maybe we should put some of this here. Okay, let's put I'm not writing perfect English here, solving buy sell DP. Okay, DP is decision problem. Okay, now what we say is see sheet. What do we, so that those who are sleeping right now can figure things out when they read the notes. See the sheet DP4 paradigms in, what is the name of the file? This is called spoon feeding. Okay, C sheet DP4 paradigms in this file thing. Okay, And if you want me to spoon feed more, I can hyperlink the file, but I think you can find the file, okay? All right, now all these further discussions are with reference to the sheet and the framework in the sheet, okay? So now we are discussing value versus price, all right? So let's just copy this, okay? How does this framework work? Now, how does this work? Calculate fair value. Okay. Calculate fair value. You know one way of calculating fair. You've already done this before. For project analysis, when you go here, what is this? Which part is this NPV model of a project? Okay, of a project's returns. Okay. Now here, which is the fair value part here? Is my question clear, Guy? Guy has an enigmatic smile on his face. Why?
Question is not clear.
Question is not clear. Okay, very good. Good. 1 minute. 1 minute. I'm asking Guy. In this NPV model, you understand what fair value is now? I think you have some idea about value or fair value. Okay. So in this NPV model that you see, which is the fair value part? This is the NPV model of a project. Okay. Now just explain to me. Point out the terms. Term 1, term 2, term 3. Which is the fair value part? Is my question clear now? In the NPV model, okay, notice what I've done here. Why are we discussing NPV now? Quiet, guys. I want everybody to pay attention here, okay? This is very important stuff, and you'll not find this in any book. It's important for you to have the perspective, okay? 1 sec. Please focus here, okay? Now, in this model, why are we discussing NPV? Remember this, projects, okay? So, all right, because what have I done? I've classified under value versus price models, okay? I have put in many kinds of models. I have put in project NPV, okay? So I'm actually saying that this project NPV business is under this family. It falls under this family of approaches. It is a value versus price based, a comparison based analysis, and that's the way you solve the buy-sell decision problem, okay? So what I'm trying to show you now, what I'm asking, is this context clear? Okay, now in this context, I'm asking you, when we go to the NPV model, you already have some idea about value and price. Okay, now I'm asking you, in this NPV model of a project cash flows, which part represents the fair value of the project? Is my question clear now?
Yes.
Okay, yes, now Guy will answer. Give him the mic. No, you answer with the mic. Yes.
Cash flows of different years.
Cash flows of different years. Actually, okay, you can say, you should say periods, but different years, fine, that's not wrong. Okay, so you're saying that these cash flows, actually what you should say is, because I asked you for the terms. I asked you for the terms in this equation, so you should say, 1 minute. I know what you meant, but what you should have said is, the PVs of the cash flows, because the entire term is here, so it's not just the cash flow, it's the PV of the cash flow. To be very specific, are you following why I'm criticizing your answer? Okay, what you should have said is the PVs of the cash flows, right? So now do you agree, Tushar?
Yes, sir.
You agree?
Yes, sir.
So if you add up the PV, so on the RHS of this equation, if you leave out the C0, which is the cost of the project, okay, the rest of it is the fair value of the project.
So, but shouldn't it be compared with the outflows, the inflows? Inflows should be compared with the outflows.
No, we'll come to that later. 1 minute. I'm not saying that it should not be compared. I am just now, at this point, I'm only focused on this question of, in this NPV model, in this representation, which part represents the fair value of the project?
RHS.
Which is on the RHS, but leaving out the C0.
Why is it?
I'm coming to that. What is my question? My question is not what is the NPV of the project. Watch my question. My question is not what is the NPV of the project. If the question was what is the NPV, then if you say RHS, then it's okay. Then the answer is correct. But my question is, what is the fair value of the project? The NPV is not the same as the fair value of the project, because the NPV has a word net in it. Okay, so be clear about this also, that the NPV is not the same thing as the fair value of the project. Is this clear? Sandha, are you following? Okay, all right. So now, is this clear that the fair value of the everyone should be clear up to this point, because I don't think there's agreement on this. Yes, Sushant? What does your notebook say? What are you studying? No, what is the point of using, what is the point of my giving you guys the notes? The whole point of it that you don't have to take notes in class. Okay, 1 minute. Alright, okay guys. So please be clear about this one point. I think even this was not clear to everybody. Be careful about how the language is used. My question was not what is the NPV of the project. If that was the question, the answer would be the RHS. Okay? Here, this is clear. My question is, what is the fair value of the project? To that, the answer is not the entire RHS. It is the RHS, but leaving out the C0. Leaving out the C0. Is this clear?
But it should be compared for.
I'm coming to that. I'm not disagreeing with you on that, but you follow my line of questioning at this point of time. Okay. So now is this clear? This is the fair value of the project. Okay, so if you look at the NPV equation, it has two parts. On the RHS, there are two parts. There is the cost of the project and there is the fair value of the project. Okay, you're comparing the cost of the project with the fair value of the project. Okay, so let's look at let's take the example of value versus so I'll write this later on. So this is the fair value. Now, is it also fair to say that the cost of the project is equivalent to the market price of the project?
Yes, sir.
Would you agree with my statement?
Yes, sir.
Yes, Nikita? You agree with my statement? That the cost of the project is equal to the market price of the project? Rahul, you agree? Anybody has a problem? I mean, I don't want to say this in a threatening way, but is everyone agreed? Kriti? Are you in agreement with my use of the language? That the cost of the project, which you are familiar with, the C0, I am now giving it a different label. I am calling it the market price of the project.
It's a current market.
Yes, current market price of the project. Do you have a problem with that change of label? Ankur?
No, sir.
You're okay? Okay. Now, why did I make this change of label? Because now I'm going to put it, yes, double A, yes.
Sir, I'm not able to.
Yeah, please use the mic. Yeah, you should. And if anytime you have any kind of doubt, even a comma, full stop, you don't understand, if you ask a question. Yes.
Sir, I don't really get what do you mean by market price of the project. Like, sir, every company when they do estimates of cost, they are different. So how can we take one single market price for the cost?
Okay, good, very good question. Okay, but effectively what we are saying is, when you finally, typically how does a project work? Let's say Delhi Metro wants to extend the line to Karnal. Okay, they will put out an invitation to tender.
Yes.
Remember the case you did in your contracts?
Yes.
Union of India versus Madala Tataya, the tendering case.
Yes.
Okay, so now what will happen? The Delhi Metro will put out a tender, invitation to tender.
Yes.
In response to that, various engineering companies will submit their tenders.
Yes, sir.
Okay, now one of the tenders will be accepted. Okay, so let's say that L&T's tender is accepted, and let's say they have quoted say $20 million to complete that line. Okay, so they'll do an end-to-end project. So they will just complete the line and deliver it to Delhi Metro. Okay, so now effectively, because they have accepted the L&T bid, presumably it was the lowest cost with quality constraints and all that. So because they've accepted the L&T project, and they took they took multiple prices from multiple vendors. So it's effectively like you going into the market and checking various market prices. Okay, and if the market is not so well organized that there's always only one price. Okay, and then eventually you found the best price. So now it's effectively like a market price. It's the cost of the project, but essentially they have outsourced the building of the project, the construction of the project. They've outsourced it, and so now you can see why the cost of the project is like the market price of the project for Delhi Metro. Are you convinced? You come through? You have no problem with the change of label. Is this clear? Okay. Now what I'm saying is, now what I want to make you understand is how the framework applies equally to all the categories that I'm going to put under the framework, okay, under this price versus value approach, okay. So now we have agreed that in the NPV of the project, if you look at the RHS, you can think of the RHS as having two parts: the fair value of the project and the market price of the project. Is this clear so far? Okay, everyone's in agreement?
Yes.
Okay. So now what are we doing here? Now let's see. Now let me just explain the framework, because we are approaching, what we are describing now is this entire category. Remember, this whole thing is two approaches. One is value agnostic and one is value versus price comparison. Okay. So in this value versus price comparison, I'm giving you an example that you're already familiar with, which is the NPV. And I'm saying that this is what the value versus price comparison analysis framework is. Calculate fair value, okay? Compare fair value to market price, okay? Okay, market price is easy. You can just get this market price, okay? In the worst case of the Delhi Metro example, you have to go through a little bit of a headache of taking tenders and evaluating the bids and all that, but eventually you can get to a market price. Is very easy, it's objective, okay? All right, then if market price less than fair value, what should we do? Buy or sell? If market price is less than fair value, buy, okay? Okay, this should actually be 3.1 and 3.2, but we'll just ignore that to save myself the time. Okay, if market price is greater than fair value, sell, okay? So this is the generalized framework. Okay, now we'll see why the NPV actually accurately fits into this framework, okay? We'll confirm that for ourselves, okay? So, if go back to the NPV equation, if market price is less than fair value, what is the market price here? C0, okay, and this is the fair value, okay. So if market price is less than fair value, in this sense, it's essentially we just ignore the signs, okay. But essentially, if this is the less than fair value, the absolute values of these two, then what will happen? NPV will be positive. If market price is less than fair value, NPV will be positive. So then when NPV is positive in your NPV project analysis framework, what would you do? You would accept the project. Okay, now can I say, is it acceptable for me to say that accepting the project is the same as buying the project?
Yes, sir.
Right? Accepting means I am willing to spend the money to invest in the project, which is the same thing as I go to the market and spend the money to buy to have a dozen bananas or whatever. Okay, I'm buying it. Okay, accepting the project means I'm buying the project. Okay, now if market price is greater than fair value, what will happen here? If the market price is greater than fair value, NPV will be negative. If negative NPV, what do? Do you accept the project? You reject the project? Okay, can I say that rejecting the project is the same as selling the project?
No, sir. No, sir.
Yes, sir.
You can't actually short sell the project, but effectively it is essentially like, I mean, obviously it's not a perfect comparison, but you don't buy the project. If NPV is negative, you don't buy the project.
Yes.
You don't invest in the project, okay? So in a sense, the opposite of buying is to sell. You're not buying the project means you're passing up on this project. You're essentially saying that because the NPV is negative, I will not invest in the project, which is, if you could go short the project, think about it. If projects were tradable, okay, they're not tradable, but if you could go short the project, why wouldn't you sell the project? Think about it. If NPV is negative, means that the market price is higher than the fair value of the project.
Yes, sir.
Okay, so if you could actually trade in project bids, okay, you would actually, because this is obviously difficult, it wouldn't happen in the real world, but conceptually if you could do it, you would sell the project means what? If you sell the project, suppose the market price of the project is $50 million, and according to you, the fair value of the project is only $30 million. So if you sell the project, you will receive $50 million.
Yes.
Yes, 20 profit.
And you are selling the project, and you have to pay up the returns of the project now, okay, because you have sold the project, you have to pay up deliver. So when you deliver the returns of the project, you're only delivering a present value of $30 million, but you're receiving $50 million. So conceptually, you can see that if you could sell projects, if you could buy and sell projects, you would sell it. Because see, think about it this way: when Delhi Metro buys the Karnal project for $50 million, who is selling the project? L&T is selling the project. The contractor is selling the project.
Yes.
Okay, so what will be his out when he sells the project? What are his inflows? The market price of the project. Let's say that Delhi Metro pays them upfront, the whole amount. So then, when L&T, look at it from L&T's point of view, L&T is selling the project and Delhi Metro is buying the project. Okay, so L&T, when they sell the project, their inflow is what? $50 million. Market price is $50 million. Okay, and what are L&T's outflows? Everything it will cost to build the project and deliver it. That's $30 million. Present value of the cost is $30 million. So they will make a $20 million profit on a PV basis. So Delhi Metro is buying it, L&T is selling it. Okay, so can you see that there is a comparison there?
Yes.
Okay, so you can see that it is accurate to fit the NPV into this framework. The broad framework is like this: calculate fair value, compare it to market price. If market price is below fair value, you buy. If market price is above fair value, you sell. Okay, in some cases you may not be able to sell. Okay, so now let's look at one more thing here: value investing. Can you see again? I'm just testing it out from different, I'm just telling you the same thing from different angles so that it gets drilled into your head. Okay, value investing is an important investment philosophy which you should be aware of. Okay, can you see that value investing is the same thing as investing in positive NPV investments?
Yes, sir.
Yes.
Because what are you doing in value investing? You calculate, this is, now let's suppose this is the fair value of a stock. This part here, the CIs, the fair value of a stock, the PVs of the CIs. Are you following? Many people are tuning out. I mean, maybe I'm over repeating the same thing.
Yes.
Okay, now we can go on. Good, good. If you are already clear, then fine. So value investing is the same as investing in positive NPV projects. Okay. So what you have to understand clearly here, I'm just giving you a perspective on these things, that there is no difference with all of these approaches. You've done bond valuation. You've done bond valuation. Okay. Stock valuation, Gordon growth model, or if you discount earnings, or if you discount, you've done enterprise value in M&A. Okay, you're valuing the whole company. Okay, same concept. Okay, essentially these are all the same concepts, and they are following into the same framework, which is value versus price. If you see how is it connected to the decision problem? When you try to connect the NPV analysis or the bond valuation or the stock valuation, etc., to the decision problem of buy or sell, that's when you see that this value versus price framework is applied. When you go from valuation to the decision problem, essentially how do you go there? You go there applying the value versus price framework, which is this. Again, people are zoning out as if I'm talking Japanese or something. Are you following what I'm saying?
Yes.
You apply your valuation techniques, and then when you go to solve the decision problem, you're essentially applying this framework, the price versus value comparison. Okay. So now can you see that there is a philosophical difference between, there's an important philosophical difference between the TA approach and all these FA approaches? Can you see? Because in TA you are not concerned with value at all. You don't really care what value is. Okay. Whereas in this approach, you are always comparing price to value. Is this clear? Kalra? Making sense? You're looking a bit zoned out.
Yes.
Not enough coffee in the morning. What happened? Are you following? Okay. Okay. Alright. So, and I just wanted to give you this. I hope it's not confusing. It's meant to be not confusing, because you need to know about these things. You need to know where everything goes. Okay. Now typically you notice that later on when you do courses on modeling and stuff like that in the industry and all that, you'll find typically most of the time it tends to focus on this, or you end up doing balance sheet and all those kind of P&L forecasting and things like that. Okay, but there is another category of models. Okay, that's why I see within this category also, within this value versus price, I've given two categories. Okay, one is called AFV. AFV stands for, is it written here? That's not been written. That hasn't been written here. let's write it here and then write it here also. AFB is what? Do you remember this term? What is it? I've used it before. Okay. Now, in plain English, what this really means is, if I were to explain it using a longer sentence, arbitrage-free valuation means any valuation which is done in a way that ensures that there are no arbitrage opportunities. Okay, so here now you need to understand something called, I think I'm not going to go into that maybe at this stage. I'll come back to this framework a little bit later because I want to get into the option model. But let's understand this as only one type of arbitrage. There's one type of valuation which is very different from forecast-based valuation. All these things I'm calling forecast-based valuation. Stock valuation, project valuation, I'm calling it forecast-based valuation. Why? Because what is the big forecast here, guys? What is the big forecast here?
Present value of cash.
Present value is not the forecast, but the cash flows are the forecast. The project cash flow, which is the long discussion that we had in the earlier part of the class, which is that this is where the risk is. The cash flows are all just forecasts. So forecast has no, I mean, it's basically very uncertain. Okay, there's no guarantee that it will come true. Okay, so that's why I'm calling it. You'll see that all these approaches, they are all based on forecasts. Okay, you're forecasting the dividends of the stock. That may or may not turn out to be true. You are forecasting the returns from the project. That forecast may well turn out to be wrong. Are you following what I'm saying?
Yes, sir.
Yes, Tushar? You're also falling asleep. If you're not following, then you should tell me what is the problem. Are you following why I'm calling these approaches all forecast-based valuation?
No, sir. So can you repeat?
Yeah, so you were not paying attention. It's just, you understand this expression forecast-based valuation? Okay, so I'm applying that to all these approaches. And why am I calling it forecast-based valuation? Because the valuation is based on forecasts. Okay, it is critically dependent on forecasts, and which is here the most important forecast is these things, the cash flows. Okay, the cash flows of the project. This is the crucial part of the exercise. This is what goes where you have massive errors. Okay, then, and this is nothing but a forecast. Okay, is this clear to everyone?
Yes.
So you have to be aware of this. So that's why I'm calling these all these approaches forecast-based valuation, because all of them have the same property. They are all crucially based on the forecasts of the project returns or the asset returns in general terms. Okay. All right. So that's why this category of valuation techniques, both are value versus price. Both AFB and FBV, both are value versus price. But there is an important difference between these kinds of approaches and these approaches, because these are based on forecasts. Okay, and AFB I'm not going to go into right now. Okay, but I'm just giving you the categorization. Okay, I'm just giving you the how to understand this. Okay, that there's a category of valuation models called AFB, and typically you'll find most of your courses, or industry courses, will not address this part, the AFB valuation models. Okay, some will. But essentially these are, what are these? These are all these models. Pricing of FX forwards, pricing of futures, pricing of FX cross rates. Okay, this is just for your information at this stage. I'll explain it to you later when we come back to this framework. All option pricing models are also AFB models. Okay, but there is a problem here. This is AFB because the methodology that is used is the AFB methodology, but it's actually not AFV. It's not actually arbitrage free. Okay, so that's why I'm calling it improperly so called. These are called AFP models, but they're actually not arbitrage free. Okay, so at this point you just understand this. Obviously you don't understand everything because I've not explained what is arbitrage and all that. Okay, but we don't have time to go into this. I'll come back to this later. Okay, but we are just making the categorization. You should be aware that there is also another category of models. Okay, that's why I'm giving you this framework for perspective, so that you know whatever you're doing, where does it sit in the larger scheme of things. So there's also a big category of models called AFB models, out of which again you have two subcategories. Some of these things which you should be aware of, like FX forwards, you know what FX forwards are. Pricing of valuation of FX forwards, this is a classic case of arbitrage free valuation. Okay, this is really arbitrage free, and it's a very different, so this is not really subjective. So these models are actually not subjective. The AFB properly so called is not subjective. Okay. all, let me just write this important point, because as I said, I confirmed Vibhu's view that valuation is subjective and price is objective, okay? But there is an exception to that, okay? But I'll just write that down. All valuation is subjective and price is objective, okay? There is one exception to that. Exception is is not subjective, it's objective. Okay, so this is the only exception. Okay, these kinds of models, these are actually objective because you can actually enforce the valuation, you can make the price converge to the value, okay, to the fair value. So we'll come to that later. I think if we go into this, it'll become a very long discussion. I want to progress a little bit more, but are you guys very confused if I leave the AFV discussion at this stage? Will you be very confused? I mean, if we come back to this and I want to go on to the option part of it, the pure option part of it.
You can give a brief.
Is that okay? Okay. At this point, it's like, is that at this point I'm just showing you, okay, on the map, there are these two countries, Sweden and Denmark, located over here, but you don't know anything else about what is Sweden or what is Denmark, but you know where they are located on the map, that's all. And I'll come back later to have a discussion about those countries. Is this clear? That's what we are doing. So you have a framework.
A little brief description of AFP little.
Okay, AFV, I'll just give you a very quick example of AFV, okay? So that you have an understanding of AFV, okay? Let's say Patna sugar price equal to, I'm not writing rupees per kilo or something, let us just write 45, okay? Then Delhi okay, Delhi sugar price equal to, I'm giving extreme examples, okay, and okay, so this is all rupees per kilo. Okay, so let's say you have a situation where you have the sugar price in Patna, which is 45 rupees. The shipping cost per kilo is 20 rupees, okay? And let's say you can ship instantly, okay? And let's assume that these are both, above prices are bid and offer both. There's a term in the markets which you should be aware of, choice prices. Choice prices means, a choice price means you can either buy or sell at that same price. Normally our bid is lower and the offer is higher, okay? And so that is the normal bid and offer price. So when a market maker quotes you, suppose you're asking for dollar Swiss and 20, okay? So instead of quoting 17.27, he quotes 18 choice. 18 choice means whatever the big figure is, okay? At that price you can decide to either sell to him or you can buy from him. So that's called a choice price. This is a new lingo that you're learning, okay? So bid and offer you're already familiar with. Now there's a concept of some market maker quotes you a choice price. He doesn't quote you bid and offer separately, he's quoting you a choice price. That means he'll quote you only one price and it's your choice. You can either sell to him, which means bid and offer is the same. That's all it means, okay? You can say that is basically bid and offer. Bid is equal to offer. That's what it means, okay? That's all that it means, but it's new lingo that you should learn, okay? So let's assume that the above are choice prices, okay? Right. Now, if this is what prevails in, let's understand what is, first let's understand what is AFV, okay. So at Kabat's request, we have gone into this discussion of AFV. Okay, all right. Quiet, guys. Okay. So So the question is AFB price in Delhi. Okay, what is the AFB price in Delhi? Okay, so this will give you a flavor with a very crude and simple example. This will give you a philosophical flavor for a flavor for what the philosophy of arbitrage-free valuation is. So the question we are asking in this particular little example is, what is the AFB price of sugar in Delhi? Okay, no restrictions on, okay, here let's write one more thing. I'm going to have to collapse it because it's not fitting in one view. Okay. Okay, no restrictions on UP Delhi trade. Okay, so no restrictions on shipping across UP Delhi borders and all that. Okay, no border restrictions on UP Delhi trade. Okay, then what is the AFB price in Delhi? Okay, is the question clear? Of course, other than the fact that you don't understand what AFB is, it has not been taught to you. But you tell me, okay, tell me, Bola, what should be the fair price? Patna, buy or sell at 45 rupees, choice prices. Delhi, buy or sell at 75 rupees. Okay, cost is 20 rupees to transport. Okay, no other costs. Now, is there any opportunity for you to make some money?
Yes.
I'm asking Bola, what will you do? 1 minute, be quiet, give him the mic. Now let's say if I want you to make some money out of, can you make some money out of this? What can you do?
Sir, sell it at high price.
Sell it at high price in Delhi.
Yes, sir.
You want to sell it at Delhi. Okay, so you get the Delhi dealer on the phone, left here, you tell him that you have sold to him at 75. Now you have sold to him at 75, now you have to deliver the sugar. If you sold him, let's say you sell him 10 kilos of sugar at 75.
Sir, I will include that amount, the shipment cost in my market.
No, that's okay, but I'm just coming to the first part of it. You have decided to sell to the Delhi dealer.
Yes, sir.
You've sold him 10 kilos at 75. Okay? Now the problem is you have sold him 10 kilos, so fine, he'll pay you 10 kilos into 75. But he'll pay you rupees, but you have to deliver 10 kilos of sugar to him.
Yes, sir.
Now where will you get the sugar?
Sir, from Patna.
From Patna. Okay. So that means you have to buy or sell in Patna.
Sir, buy.
You have to buy in Patna. So on the other year you have the Patna dealer.
Yes, sir.
Okay, you have already contracted with him to buy.
Yes.
Then you have to get the shipper, arrange the shipping from Patna. So let's say shipping is instantaneous. Okay, let's assume. Okay, we have what is that, Hyperloop between Delhi and Patna, so you can get very quick shipping. Okay, so now you will take the sugar which you bought in Patna, which is now being shipped, and you will deliver it to the dealer in Delhi. Okay, so you have bought from him, so you have to pay him 45 rupees.
Yes, sir.
Then you have to pay 20 rupees to the shipper. So your outflows are 65 and your inflow is 75. Okay, so you make a 10 rupees per kilo profit. Okay, is this clear? Now this simple example gives you the flavor of all arbitrage free valuation is nothing but this. Okay, in practice what might happen is, instead of, now here we have only 3 moving parts: Delhi price, shipping cost and Patna price. But in more complex examples of arbitrage free valuation, you might have like 11 moving parts. But the philosophy doesn't change. Okay, typically you will have a price which can be compared to, basically the fair value. Here what are you doing actually? Okay, let's understand why Bhola decided to sell in Delhi. Okay, why did he decide to sell in Delhi? Okay, so arbitrage free will come to this. Okay, so why did he decide to sell in Delhi? Let's understand this. Okay, what is the process that he followed? Okay. Alright, okay, so what did he do? He calculated, the first thing he did was, so the first thing that you have to do here when you're facing a situation like this, for all kinds of buy-sell decision problems which you are deciding to solve by this technique, by using this approach, value versus price. Remember, you can also solve it using TA without any reference to value, okay? But if you decided to solve it using value versus price, the first thing you should look at for any kind of situation is, can I apply AFV? Is it possible for me to apply a AFV, okay, and properly so called, that is, let's call it true AFV, okay? Can I apply AFV? Is it possible to apply AFV? The first thing you should check. So what Bola does is he checks this. What is the fair value? Can I calculate it using AFV? Okay. So what he does is here, calculate the fair value. Now if he sees that price in Delhi, the sugar in Delhi is the same as sugar bought. One is sugar in Delhi, you have the real sugar in Delhi, in the market in Delhi, but the synthetic equivalent of that, you think about an equivalent. Okay, you visualize a synthetic equivalent. You understand what a synthetic equivalent is?
Yes, sir.
A kind of like an artificial equivalent, which has the same effect, but it is not quite the same thing which you see. So synthetic equivalent of price in Delhi is, okay, let's call this here, let's bring this here. Okay, AFV means here you compare it to, is there a synthetic equivalent price for Delhi sugar? Okay, is there a synthetic equivalent price for Delhi sugar? The answer is yes, and that is what? That is sugar bought in Patna, which has been bought in Patna but transported from Patna to Delhi. If you are able to do that, it is the same as sugar bought in Delhi.
Yes, sir.
This is clear? Everyone follows? Yes. So that's what I'm calling a synthetic equivalent, okay? So it is not originally sugar that was maybe grown in the neighboring fields and brought to the market in Delhi, but it is actually equivalent because you bought it in Patna and you had it shipped over, but it's the same quality of sugar. So it is a synthetic equivalent of sugar in Delhi in this context. Is this clear? Are you following?
Yes.
Money, you're following? Okay, alright. So is there a synthetic equivalent price for Delhi sugar? Okay, that price is the AFV. 1 minute. That price is the AFV of Delhi sugar. AFV is arbitrage free value. Okay, so that price is the fair value using AFV of. Make sure you understand the statement. Okay, who was the person saying done, sir, done? Who? Jasprit. Okay, 1 minute. Let's complete this one part, okay? This last part, okay? So calculate fair value. So you find, first you ask, is there a synthetic equivalent, okay, for Delhi sugar? And that price, the synthetic equivalent price, will be the fair value using AFV. Make sure you understand why I'm writing the language like this. Make sure you understand these are all new concepts. So first you understand the concept of synthetic equivalent. You try to observe the situation and see if there is a synthetic equivalent for Delhi sugar, and if it exists, okay, the price of that synthetic equivalent. Here the synthetic equivalent is buy in Patna, ship it over to Delhi. So it's not just 45 but 45 plus 20. Okay, to make it equivalent you have to ship it over. So the price of the synthetic equivalent is the fair value using AFV of Delhi sugar. Okay, now what will happen? When will AFV break down? If I change this from no border restrictions, so if I put up checkpoints in Delhi, no trade between Delhi and UP, and assuming you can't get out, come through maybe Madhya Pradesh, maybe come through like other states or something. So only way to get to Delhi is through the Delhi-Patna Bihar border, okay? Delhi through UP and all Bihar and all that, okay? So if I put border restrictions, then is there a synthetic equivalent?
Yes, sir.
No.
You can't ship it. Let's say I put a restriction saying this is not well written, that I'm imagining that Bihar and Delhi are adjoining, okay? But the point is, well, this is actually Bihar is not in UP, but so let's just assume that Bihar is in UP, okay? Now, okay guys, now is this clear? Now understand this last point and I'll let you go, okay? That if I set up border restrictions, if I don't allow you to ship, then it is no longer,
Synthetic equivalent.
it's not an equivalent. You can't arbitrage the price because you can't buy sugar from Patna and ship it to Delhi if I put up restrictions. So we'll discuss this in the next class. I have taken only how much time? Okay, 2 minutes. That's not much. Okay.